Welcome to a journey through the history of Bitcoin, the world's first cryptocurrency. Bitcoin is a decentralized digital currency that operates without a central authority or banks. It is characterized by four key features. It's decentralized with no controlling authority. It's entirely digital. It enables peer-to-peer transactions, and it has a limited supply of only 21 million coins. In this video series, we'll explore Bitcoin's history from its mysterious beginnings in 2008 to its current status in 2025. Bitcoin has evolved through distinct phases, from its experimental beginnings through periods of growth and mainstream awareness to today's institutional adoption era. In this video series, we'll uncover the fascinating story of Bitcoin, from its creation and mysterious founder through key historical events, market trends, and technological evolution to its current status as a significant force in the financial world. Now, let's begin our journey through the history of Bitcoin. Bitcoin's story begins on January 3, 2009, with the creation of the Genesis block. This first block, also known as Block 0, was mined by Bitcoin's creator, Satoshi Nakamoto, marking the beginning of the Bitcoin blockchain. What makes the Genesis block special is that it contained a hidden message in its Coinbase parameter, which reads, "The Times 03 Jan 2009, Chancellor on brink of second bailout for banks." This message directly references a headline from the Times newspaper published on that same day. This message served two important purposes. First, it provided undeniable proof that the block was created after this newspaper was published, establishing a verifiable timestamp. Second, and perhaps more importantly, it served as a powerful commentary on the traditional financial system that Bitcoin was designed to disrupt. The headline referenced governments bailing out banks during the 2008 financial crisis. By embedding this message, Satoshi Nakamoto made it clear that Bitcoin was created as an alternative to a financial system that required government intervention to survive. This philosophical statement became the foundation of Bitcoin's purpose. From this first block, Bitcoin began its journey to become a revolutionary digital currency. The Genesis block remains forever special in Bitcoin's history as the foundation stone of an entirely new financial paradigm. Satoshi Nakamoto is the enigmatic creator of Bitcoin. To this day, their true identity remains a complete mystery. In October 2008, Nakamoto published a revolutionary white paper titled Bitcoin, a peer-to-peer electronic cash system. This 9-page document laid the foundation for what would become the world's first decentralized cryptocurrency. The white paper described Bitcoin as a peer-to-peer electronic cash system that would allow online payments to be sent directly from one party to another without going through a financial institution. This revolutionary concept eliminated the need for trusted third parties in digital transactions. Despite numerous investigations and claims, Satoshi Nakamoto's true identity remains unknown. Some believe Nakamoto is a single programmer, while others suspect a group of cryptographers or even a government entity. The creator's deliberate anonymity has become an integral part of Bitcoin's decentralized ethos. Satoshi Nakamoto is estimated to own about 1 million Bitcoins, mined during Bitcoin's early days, which have remained untouched. Their disappearance from the Bitcoin community in 2011 has only deepened the mystery, leaving behind a revolutionary technology that continues to evolve independently of its creator. In the early days of Bitcoin, from 2009 to 2010, the cryptocurrency was primarily used by a small group of enthusiasts. These early adopters were mainly cryptography enthusiasts, computer scientists, and cypherpunks, who saw Bitcoin's potential to revolutionize finance. One of the most famous early transactions occurred on May 22, 2010, a date now celebrated as Bitcoin Pizza Day. Programmer Laszlo Hanyecz posted on a Bitcoin forum offering 10,000 Bitcoins for 2 large pizzas. A fellow forum user took Hanyecz up on his offer and ordered 2 large pizzas from Papa John's for him, completing what would become the first real-world transaction using Bitcoin. At the time, those 10,000 Bitcoins were worth roughly $41. This established the first recorded price of Bitcoin at about 0.4 cents per coin. In today's terms, those same pizzas would be worth hundreds of millions of dollars. By March 2025, with Bitcoin reaching over $100,000, those 10,000 Bitcoins would be valued at more than $1 billion. This transaction marked a crucial milestone in Bitcoin's history. It proved that Bitcoin could be used for real-world purchases and established its first tangible valuation against traditional currency. Following this historic transaction, interest in Bitcoin began to grow, leading to the establishment of the first Bitcoin exchanges. The rise of Bitcoin exchanges marked a crucial development in Bitcoin's history. As Bitcoin gained popularity between 2010 and 2013, the need for platforms to buy and sell it became increasingly apparent. A Bitcoin exchange is essentially a marketplace where users can buy and sell Bitcoin using traditional currencies or other cryptocurrencies. Exchanges provided the critical infrastructure needed to convert between Bitcoin and traditional money, making it accessible to more people. Let's look at the timeline of major early Bitcoin exchanges that emerged between 2010 and 2013. Mt. Gox, launched in July 2010, quickly became the largest Bitcoin exchange, handling over 70% of all Bitcoin transactions by 2013. TradeHill launched in 2011, briefly becoming the second largest exchange before shutting down due to regulatory issues. Bitstamp, founded in 2011, became one of the longest-running exchanges and remains operational today. Coinbase launched in 2012, eventually growing into one of the largest cryptocurrency companies globally. BTC appeared in 2011, becoming notorious for its anonymity and later shut down by authorities. Early Bitcoin exchanges faced significant security challenges that would later lead to several high-profile breaches. These platforms often had inadequate security practices, making them vulnerable to hackers. They frequently lacked proper cold storage solutions and security audits. Regulatory uncertainty was another major challenge for early Bitcoin exchanges. The legal status of Bitcoin was unclear in most jurisdictions. There were no standardized procedures for customer verification, and exchanges struggled to maintain banking relationships. Despite these challenges, early Bitcoin exchanges played a crucial role in Bitcoin's evolution. They increased Bitcoin's accessibility, provided important price discovery mechanisms, improved liquidity, accelerated mainstream awareness, and ultimately led to the development of better security practices. These early exchanges set the stage for what would become one of the most infamous episodes in Bitcoin's history, the Mt. Gox collapse. Mt. Gox was once the world's largest Bitcoin exchange, handling over 70% of all Bitcoin transactions by 2013. Founded in 2010, Mt. Gox experienced its first security breach in 2011, when hackers stole approximately 80,000 Bitcoin. Despite this early warning, the exchange continued to grow, reaching its peak in 2013. In February 2014, Mt. Gox suddenly halted all Bitcoin withdrawals. By the end of the month, the exchange had filed for bankruptcy. The collapse revealed a shocking loss of 850,000 Bitcoin, valued at approximately $450 million at the time. Today, that would be worth over $85 billion. Investigations revealed significant security flaws and mismanagement at Mt. Gox. Hackers had been stealing Bitcoin from the exchange's hot wallet for years. The Mt. Gox collapse had devastating effects on the Bitcoin ecosystem. Prices crashed by nearly 50%, and trust in cryptocurrency exchanges was severely damaged. Most Mt. Gox users never recovered their funds. The collapse became a cautionary tale that led to improved security practices across the industry. The civil rehabilitation process for creditors continues to this day. The Silk Road, an online black market operating on the dark web, became synonymous with Bitcoin's controversial early adoption. Launched in February 2011 by Ross Ulbricht under the pseudonym Dread Pirate Roberts, the Silk Road operated as a Tor hidden service, making it difficult to track users. The marketplace facilitated the sale of illegal goods and services, with Bitcoin as its exclusive payment method. This pseudonymous payment system allowed buyers and sellers to transact with relative anonymity. Bitcoin transactions on the Silk Road provided a degree of anonymity. While all transactions were recorded on the public blockchain, users' real identities could remain hidden behind pseudonymous addresses. In October 2013, the FBI shut down the Silk Road and arrested Ross Ulbricht. The agency seized approximately 144,000 bitcoins, worth around $28 million at the time, but valued at roughly $14 billion in 2025. The Silk Road Association tarnished Bitcoin's public image, with media often portraying it as a criminal currency. This negative publicity attracted regulatory scrutiny and raised concerns about cryptocurrency's role in enabling illegal activities. However, the Silk Road also inadvertently demonstrated Bitcoin's fundamental properties as a censorship-resistant payment system that could function outside traditional financial controls, highlighting both the challenges and potential of this new technology. In Bitcoin's journey, November 28, 2012 marked a critical milestone, the first Bitcoin halving. But what exactly is a Bitcoin halving? It's a programmed event in Bitcoin's code where mining rewards are cut in half approximately every 4 years. On November 28, 2012, at block height 210,000, the mining reward was reduced from 50 bitcoins to 25 bitcoins per block. This event was fundamental to Bitcoin's monetary policy. The halving mechanism creates a predictable, diminishing supply curve that will eventually cap at 21 million bitcoins. The first halving had profound effects on Bitcoin's scarcity. It reduced the new supply entering the market, increased Bitcoin's stock-to-flow ratio, created a predictable monetary policy, and established Bitcoin's deflationary nature. The market impact was substantial. Before the halving in November 2012, Bitcoin traded at around $12. 1 year later, the price had surged to approximately $1,000, an extraordinary 8,300% increase. The first Bitcoin halving established a critical precedent for all future halvings and cemented Bitcoin's long-term monetary policy as one of its most valuable features. Bitcoin's early years were characterized by extreme price volatility, with dramatic swings that would become a defining feature of the cryptocurrency. From 2010 to 2013, Bitcoin experienced several major price bubbles and crashes that tested early investors. In July 2010, Bitcoin was first traded for just pennies, rising from under 1 cent to 8 cents. June 2011 saw Bitcoin's first major bubble, surging from $1 to $32 before crashing back to $2, a 94% drop. April 2013 brought another dramatic rise, driven by the Cyprus banking crisis, with prices reaching $266 before falling to $50. The November 2013 bubble saw Bitcoin hit $1,150 as Chinese investors poured in and U.S. Senate hearings legitimized it before dropping to $500. Several factors contributed to Bitcoin's extreme price volatility during these early years. Market immaturity and low liquidity meant small trades could cause large price movements. News events and regulatory developments frequently triggered dramatic swings, and limited use cases meant Bitcoin was primarily driven by speculation. These dramatic price swings tested the resolve of early Bitcoin investors, highlighting both the enormous potential rewards and significant risks associated with the emerging cryptocurrency. Bitcoin's journey toward mainstream acceptance was gradual but significant. From 2010 to 2015, Bitcoin transformed from an obscure digital experiment to a recognized financial asset. Merchant adoption grew exponentially during this period, with the number of businesses accepting Bitcoin increasing from just a few in 2010 to over 100,000 by 2015. The infrastructure supporting Bitcoin also expanded rapidly. Bitcoin ATMs, which first appeared in 2013, grew to over 500 installations worldwide by the end of 2015. Several milestone adoptions helped legitimize Bitcoin as a payment method. In 2012, WordPress became the first major platform to accept Bitcoin payments, opening the door for millions of users to transact with cryptocurrency. By 2014, major retailers began to embrace Bitcoin. Overstock.com became the first billion-dollar retailer to accept Bitcoin payments. That same year, tech giant Microsoft began accepting Bitcoin for digital content in the Xbox and Windows stores, signaling growing trust from established corporations. In 2015, PayPal took a significant step by allowing its merchants to accept Bitcoin through partnerships with payment processors. Beyond merchant adoption, several other factors helped to legitimize Bitcoin during this period. Media coverage evolved from treating Bitcoin as a curiosity to serious financial reporting, reaching mainstream audiences. Venture capital investment in Bitcoin startups exceeded $400 million by 2015, with well-known investors backing the ecosystem. Academic institutions started offering courses on Bitcoin and blockchain technology, with NYU, Stanford, and MIT leading the way. This growing acceptance among businesses, investors, and academic institutions helped legitimize Bitcoin, transforming it from an experimental technology to a recognized financial innovation, and paving the way for its future growth. The block size debate marked a pivotal moment in Bitcoin's history. As Bitcoin's popularity and adoption grew between 2015 and 2017, the network began to face serious scalability challenges. At the heart of the problem was Bitcoin's 1 megabyte block size limit. Each block in the blockchain could only contain up to 1 megabytes of transaction data, a limit originally implemented by Satoshi Nakamoto as a security measure. As Bitcoin's popularity surged, more transactions competed for limited block space. This created a backlog of pending transactions, leading to longer confirmation times and higher transaction fees as users competed to have their transactions processed. The community became divided into two main camps. On one side, small blockers wanted to keep the 1 MB limit to preserve decentralization and focus on off-chain scaling solutions like the Lightning Network and segregated witness. On the other side, big blockers advocated for increasing the block size to allow more transactions per block, resulting in lower fees and faster confirmations. The debate played out over several years with multiple proposals. In 2015, Bitcoin Improvement Proposal 101 suggested increasing to 8 megabytes blocks. In 2016, Bitcoin Classic proposed a more modest 2 megabytes increase, while Bitcoin Unlimited advocated for flexible block sizes determined by miners. By mid-2017, SegWit, a solution favored by small blockers, was activated, but the debate had reached a breaking point. Unable to reach consensus, the Bitcoin community experienced a hard fork on August 1, 2017. A group of developers, miners, and users who favored larger blocks created Bitcoin Cash. This new cryptocurrency increased the block size to 8 megabytes, allowing for more transactions per block. Meanwhile, the original Bitcoin chain maintained the 1 megabytes limit, but implemented SegWit to optimize block space usage. The block size debate represented one of the most significant ideological and technical divides in Bitcoin's history. It highlighted fundamental questions about what Bitcoin should be: a high-security settlement layer or an everyday payment system. This split continues to influence approaches to cryptocurrency scaling and governance to this day, with both Bitcoin and Bitcoin Cash pursuing their distinct visions of digital currency. In 2017, the cryptocurrency world witnessed an explosive new phenomenon: initial coin offerings, or ICOs. Initial coin offerings, or ICOs, emerged as a revolutionary fundraising mechanism where blockchain projects sold digital tokens to investors in exchange for Bitcoin or Ethereum. The ICO process was straightforward. Projects would create tokens, set a price and sale period, and investors would send Bitcoin or Ethereum in exchange for these new tokens. Throughout 2017, ICO funding exploded from just $300 million in January to over $6.5 billion by December, representing one of the fastest-growing fundraising methods in history. Some ICOs, like Ethereum, EOS, and Filecoin, were legitimate projects that raised millions or even billions of dollars and delivered substantial returns to early investors. However, the ICO boom had a dark side. Many offerings turned out to be outright scams with promises of unrealistic returns. Most lacked viable products or clear roadmaps and operated in a regulatory gray area. By the end of 2018, more than 80% of all ICOs had failed. Several ICOs became infamous for their massive fraud. BitConnect collapsed as a $2.6 billion Ponzi scheme. Pincoin disappeared with $660 million in an exit scam. And OneCoin may have defrauded investors of over $4 billion with a completely fake blockchain. Despite the failures and frauds, ICOs left a lasting impact on cryptocurrency. They democratized fundraising for blockchain projects and led to increased regulatory scrutiny. Eventually, ICOs evolved into more regulated offerings like STOs. While ICO excesses contributed to the 2018 crypto market crash, they also paved the way for future token sale models. After the exuberant bull run of 2017, cryptocurrency markets faced a dramatic reversal. Bitcoin's price collapsed from its peak of nearly $20,000 in December 2017. By December 2018, Bitcoin had fallen over 80% to around $3,500. The entire cryptocurrency market capitalization plummeted from over $800 billion to under $100 billion. The crypto winter unfolded gradually throughout 2018, with several key events accelerating the decline. In January, major exchanges in South Korea faced regulatory crackdowns, while Facebook banned cryptocurrency advertisements. March saw Google follow with its own crypto ad ban, while the Mt. Gox trustee was revealed to have sold large amounts of Bitcoin. By August, the SEC had rejected multiple Bitcoin ETF proposals, further dampening market sentiment. November brought the contentious Bitcoin Cash hard fork, triggering another sharp market decline. The crypto winter proved fatal for many blockchain projects. Over 1,000 cryptocurrencies became effectively worthless. Despite the price collapse, Bitcoin's core development continued. Transaction volumes remained relatively stable, and the community showed remarkable resilience. The crypto winter highlighted crucial lessons about market cycles, speculation, and the importance of sustainable development. Projects with real utility persevered, while many speculative assets vanished. This difficult period tested Bitcoin's resilience and set the stage for future maturation of the cryptocurrency ecosystem. As Bitcoin emerged from the crypto winter of 2018, a significant shift began to take place in the financial world. For the first time, major institutional investors began showing serious interest in Bitcoin as an asset class, marking a crucial evolution in its journey. In 2018, Fidelity Investments, one of the world's largest financial services providers, announced the launch of Fidelity Digital Assets, a platform offering cryptocurrency custody solutions specifically for institutional clients. By 2019, Grayscale's Bitcoin Trust had surpassed $2 billion in assets under management, providing a regulated investment vehicle that allowed institutions to gain Bitcoin exposure without directly holding the asset. The trend accelerated dramatically in 2020 when MicroStrategy, a publicly traded business intelligence company, made the unprecedented decision to convert $425 million of its treasury reserves into Bitcoin as an inflation hedge. These institutional investors accessed Bitcoin through various specialized financial products designed to address their specific regulatory and security requirements. Several major financial institutions led this shift toward Bitcoin adoption, each creating specialized offerings for institutional investors. This institutional interest caused dramatic growth in Bitcoin investment vehicles. Grayscale's Bitcoin Trust, for example, grew from less than $1 billion in 2018 to nearly $5 billion by the end of 2020. The emergence of institutional interest had profound implications for Bitcoin. It enhanced market liquidity, reduced price volatility, improved regulatory clarity, and most importantly, provided legitimacy in mainstream financial circles. This institutional adoption marked a pivotal moment in Bitcoin's history, transforming it from a speculative digital asset to a legitimate alternative investment considered by the world's largest financial institutions. Bitcoin's monetary policy includes a unique feature called halving events, which reduce the rate of new Bitcoin creation over time. Bitcoin halving is a process where the reward for mining new blocks is reduced by half. This event happens approximately every 4 years. The halving is programmed to occur every 210,000 blocks, which takes about 4 years at Bitcoin's regular block production rate. This mechanism creates a controlled, predictable supply that becomes increasingly scarce over time. Due to this halving schedule, only 21 million Bitcoins will ever exist, with the final Bitcoin projected to be mined around the year 2140. Let's examine the key halving events that have occurred so far, focusing on 2016 and 2020. Bitcoin follows a predictable halving schedule, starting with the first halving in 2012, followed by events in 2016, 2020, and most recently in 2024. The second Bitcoin halving occurred on July 9, 2016, at block height 420,000. This halving reduced the block reward from 25 Bitcoins to 12.5 Bitcoins per block. At the time of the halving, Bitcoin was trading at approximately $650. 1 year after the 2016 halving, Bitcoin's price had increased to around $2,500, an impressive gain of nearly 300%. This chart shows Bitcoin's price movement from the 2016 halving through the following year, demonstrating the significant price appreciation that followed. Moving forward to the third Bitcoin halving in 2020, which occurred during a very different global economic context. The third Bitcoin halving took place on May 11, 2020, at block height 630,000. This halving reduced the block reward from 12.5 Bitcoins to 6.25 Bitcoins per block. At the time of the halving, Bitcoin was trading at approximately $8,800. 1 year after the 2020 halving, Bitcoin's price had surged to around $55,000, representing a remarkable 525% increase. This halving occurred during the COVID-19 pandemic amid unprecedented monetary expansion by central banks worldwide. This chart illustrates Bitcoin's dramatic price movement from the 2020 halving through the following year, showing an even more substantial price increase than the previous halving cycle. Let's conclude by examining the broader economic impact of these halving events on Bitcoin's scarcity and value proposition. Bitcoin's halving events reinforce its predetermined scarcity, a cornerstone of its value proposition. Historically, halvings have preceded significant bull markets, though past performance doesn't guarantee future results. Each halving reduces Bitcoin's inflation rate by 50%, making it increasingly scarce over time. Halvings increase the cost of production for miners, potentially driving inefficient miners out of the market. These scheduled supply reductions strengthen Bitcoin's positioning as digital gold and a potential hedge against inflation. As we've seen, the 2016 and 2020 halving events were pivotal moments in Bitcoin's history, with significant implications for its economics and market behavior. As Bitcoin matured, new blockchain applications emerged. From 2019 to 2020, one of the most significant developments was the rise of decentralized finance, or DeFi. Decentralized finance, or DeFi, refers to blockchain-based financial services that operate without traditional intermediaries like banks or brokers. Unlike traditional finance, which relies on a hierarchical system of central banks and financial institutions, DeFi creates peer-to-peer financial services using blockchain technology and smart contracts. DeFi offers a wide range of financial services, including lending, borrowing, trading on decentralized exchanges, and yield farming, which allows users to optimize returns by providing liquidity to various protocols. Bitcoin plays a crucial role in the DeFi ecosystem. It serves as a store of value, providing stability in the volatile crypto market. Through wrapped Bitcoin, or BTC, Bitcoin can also be used as collateral across various DeFi platforms. DeFi experienced explosive growth since 2020. Total value locked, or TVL, a key metric measuring assets deposited in DeFi protocols, grew from just $10 billion in 2020 to a peak of $180 billion in 2021. After declining in the 2022 bear market, it recovered to over $160 billion by 2024. Several major protocols emerged as leaders in the DeFi space. MakerDAO and Aave pioneered decentralized lending, while Compound introduced algorithmic interest rates. Uniswap revolutionized token trading, and Curve Finance optimized stablecoin exchanges. DeFi's innovation and growth paved the way for wider cryptocurrency adoption, setting the stage for Bitcoin's next major bull run. Bitcoin's 2020-2021 bull run marked one of the most dramatic price increases in its history. The year 2020 began with Bitcoin trading around $7,000, continuing its recovery from the 2018 bear market. In March 2020, as COVID-19 triggered a global market panic, Bitcoin crashed to $3,800, losing nearly 50% of its value. However, this marked the beginning of an extraordinary recovery. By mid-2020, Bitcoin regained its pre-crash levels as concerns about inflation and currency debasement grew amid massive government stimulus programs. A major catalyst came in August 2020 when MicroStrategy, led by Michael Saylor, announced a $250 million Bitcoin purchase as a Treasury reserve asset. Then, in October, PayPal announced it would allow users to buy, hold, and sell cryptocurrency directly from their PayPal accounts, bringing Bitcoin to its 346 million users. By January 2021, Bitcoin's price had surged to $29,000, quadrupling in just 9 months. February 2021 saw electric vehicle manufacturer Tesla invest $1.5 billion in Bitcoin and announce plans to accept it as payment, sending the market soaring. The bull run reached its peak in April 2021, when Bitcoin achieved an all-time high of $64,000, coinciding with cryptocurrency exchange Coinbase going public on the Nasdaq. Following this peak, the market experienced a correction, with Bitcoin retreating to around $35,000 by July 2021. Several key factors drove this remarkable bull run. Institutional adoption shifted the market dynamics as corporations and financial institutions began treating Bitcoin as a legitimate asset class. COVID-19 stimulus programs and unprecedented monetary policy fueled inflation fears, leading investors to seek alternative stores of value. Meanwhile, growing mainstream awareness and increased retail investment further propelled Bitcoin's rise. Despite the subsequent correction, the 2020-2021 bull run fundamentally changed Bitcoin's status in the financial world. It solidified Bitcoin's position as a leading cryptocurrency and attracted unprecedented institutional and mainstream attention. In January 2024, the Securities and Exchange Commission made a historic decision that changed Bitcoin's trajectory forever. After years of rejections, the SEC finally approved the first U.S. Bitcoin exchange-traded funds, marking a watershed moment for cryptocurrency. Bitcoin ETFs allow investors to gain exposure to Bitcoin's price movements without the complexities of directly owning or storing the cryptocurrency. Unlike direct Bitcoin ownership, which requires private keys and secure storage, ETFs are traded on traditional stock exchanges using existing brokerage accounts. The ETF approval triggered a wave of institutional adoption, with financial giants like Fidelity and Goldman Sachs launching services to facilitate crypto trading. These developments significantly boosted Bitcoin's legitimacy in mainstream finance and made it accessible to millions of retail investors through conventional investment channels. Following the ETF approvals, Bitcoin saw substantial inflows of capital, with ETF assets under management quickly growing into billions of dollars. The integration of Bitcoin into mainstream financial products has created a bridge between traditional finance and the cryptocurrency ecosystem, paving the way for further institutional adoption. The SEC's approval of Bitcoin ETFs represents one of the most significant milestones in Bitcoin's journey toward mainstream acceptance and legitimacy. On April 20, 2024, Bitcoin underwent its fourth halving event. This landmark cryptocurrency occurrence reduced the mining reward from 6.25 to 3.125 Bitcoin per block. The Bitcoin halving is a pre-programmed event that occurs approximately every 4 years, or more precisely, every 210,000 blocks. This process systematically reduces the rate at which new Bitcoins are created. Looking at Bitcoin's history, we can see a pattern of halvings. The first occurred in 2012, reducing the reward to 25 Bitcoin. Subsequent halvings in 2016 and 2020 further cut the reward to 12.5 and 6.25 Bitcoin, respectively. The 2024 halving reduced the block reward to 3.125 Bitcoin. This continues Bitcoin's disinflationary design, making it increasingly scarce over time. Bitcoin's supply follows a predictable curve approaching the maximum of 21 million coins. Each halving slows down the issuance rate, making new Bitcoin increasingly scarce. The 2024 halving reinforces Bitcoin's scarcity. With over 19.5 million Bitcoin already mined and only 1.5 million left to be created, new supply is increasingly limited. The next halving in 2028 will further reduce the block reward to just 1.5625 Bitcoin. Historically, halvings have been followed by significant price increases due to the reduced supply meeting constant or growing demand. The 2024 halving is expected to influence Bitcoin's price in the coming years, though market dynamics are complex and affected by many factors. The 2024 halving represents another crucial milestone in Bitcoin's pre-programmed monetary policy. As we look ahead to the 2028 halving, Bitcoin's scarcity will continue to increase, potentially affecting its value proposition as a store of value. As of March 2025, Bitcoin has entered a significant bull market. Bitcoin broke the $100,000 barrier in late 2024, a major milestone in its history. Institutional adoption is dramatically increasing, with major financial firms significantly expanding their cryptocurrency offerings. Cryptocurrency ownership has nearly doubled since the end of 2021, rising from approximately 42 million to 81 million users globally. Many leading analysts predict Bitcoin could reach between $180,000 and $250,000 by the end of 2025. This growing institutional involvement, combined with increasing global adoption, has created a robust foundation for Bitcoin's continued growth through 2025. Regulatory developments continue to shape the Bitcoin landscape, providing both challenges and opportunities for the cryptocurrency. In January 2024, the SEC made a landmark decision by approving Bitcoin ETFs, allowing institutional investors easier access to Bitcoin without directly owning the cryptocurrency. Following this breakthrough, the SEC also approved Ether ETFs in July 2024, further legitimizing the cryptocurrency market and providing additional investment vehicles for traditional finance. These regulatory approvals had a significant impact on the market, with institutional investment in Bitcoin more than doubling as traditional financial institutions gained clearer pathways to participate. Political factors have also significantly influenced Bitcoin's trajectory. Donald Trump's return to the White House is widely believed to create a more favorable environment for cryptocurrencies. Perhaps most intriguing is the emerging discussion about the United States potentially adopting a Bitcoin strategic reserve, similar to gold reserves. This concept represents a dramatic shift in how nations might approach Bitcoin as a store of value. As regulatory frameworks continue to evolve and political landscapes shift, Bitcoin's position within the global financial system becomes increasingly integrated and normalized. Bitcoin's future outlook remains a topic of intense speculation and interest. As we look beyond 2025, Bitcoin's trajectory remains uncertain, yet its history suggests it will continue to evolve and adapt. Three main factors could drive Bitcoin's price higher: increasing demand, Bitcoin's capped supply of 21 million coins, and growing institutional investments. However, Bitcoin faces significant risks: persistent volatility, evolving regulatory challenges, and increasing competition from thousands of alternative cryptocurrencies. Major financial institutions and analysts have made bold predictions for Bitcoin's price, with most projecting values between $180,000 and $250,000 by the end of 2025. Several key trends will shape Bitcoin's future: deeper integration with traditional finance, clearer global regulations, improved user experience, enhanced security, and scaling solutions. Bitcoin's future will ultimately be determined by the balance between its growth potential and persistent risks. Whatever its price trajectory, Bitcoin has fundamentally changed the future of money and global financial systems. As we move forward, the only certainty is that Bitcoin will continue to surprise, challenge, and transform our understanding of value. From its humble beginnings as a white paper in 2008 to its current status as a mainstream financial asset in 2025, Bitcoin has traveled an extraordinary journey. Bitcoin's 17-year history has been marked by remarkable milestones, from the mining of the Genesis block in January 2009 through multiple bull and bear markets, the establishment of exchanges, halvings, and finally to mainstream adoption with ETFs and institutional investment. The impact of Bitcoin on the global financial system cannot be overstated. With a market cap that has grown from zero to over $2 trillion, Bitcoin has demonstrated unprecedented growth and resilience. Throughout its evolution, Bitcoin has remained true to its core principles: decentralization, limited supply, transparency, and security through cryptography. These foundational elements have withstood the test of time and scrutiny. Looking ahead, Bitcoin's influence on finance, technology, and even governance systems is likely to expand. As institutions continue to adopt Bitcoin and regulatory frameworks mature, the original cryptocurrency is positioned to play an increasingly important role in the global financial ecosystem. Bitcoin's enduring legacy is not just as a digital currency or investment asset, but as a technological innovation that has sparked a revolution in how we think about money, trust, and the future of our financial systems. Thank you for joining us on this journey through the history of Bitcoin, from a revolutionary idea to a global phenomenon that continues to evolve and shape our world.